welcome to lesson 2, auction market theory. If you don't know who I am, I'm a 19-year-old order flow trader, and I made around $8,000 in pure trading profits last month, and here are some of my payout credentials. Just so you know, I'm not bullshitting and other stuff, right? There's a lot of gurus that do that. Here's my $1,000 Seiko watch that I picked up last month, and let's get started because I hate LARPing, and I'm not here to flex on you guys. I'm here to help you guys and to give a free path because I'm done with people putting a paywall on the most basic of information and charging people thousands of dollars to learn a skill where they are meant to lose thousands of dollars already trying to learn it by themselves. And okay, let's move on. Welcome to auction market theory. This is lesson 2, and today we aren't talking about a guru strategy. I'm not talking about my 100% win rate strategy that made me $1 million, right? We're talking about the framework that governs basically every financial market in existence. It's called auction market theory, AMT for short, and you can think of AMT as like the invisible map. It doesn't tell you exactly when to click buy. It tells you where you are in the market, where the crowd is, and most importantly, it tells you where the market is likely to move next, right? Or is likely to do next. So many different applications of it, and we'll go all over it this video. So what we're going to go over today is the bell curve, okay? The cycle of balance and imbalance. The 80% rule that most people don't know about or that ignore completely. And yeah, let's get straight into it. What's up, guys? Welcome to lesson 2 to auction market theory. This, even though it's the beginning, I think it's one of the most important lessons that you will forever use if you trade order flow. It's in the back of your head. You won't think about it. You won't be like, oh, I'm going to trade AMT today, auction market theory. You know, I would say if you have any experience with ICT, this is very, very similar to AMD, but it's just, in a sense, for order flow, if you know what I mean. AMD is a little different. AMD is ICT. So, welcome to auction market theory, and a little background on this. This isn't a strategy, quote unquote. This is framework. There is no such thing as a strategy that has like 1,000,000% win rate. You create your own strategies, right? Don't get me wrong, but this is a framework. This is a theory about how the financial market exists. So you can think of AMT as like an invisible map. Basically, it doesn't really tell you when to click buy or when to click sell and when to make money, but it's kind of like a general context of the market, right? Because I'll go into more detail later, but how market or how the AMT, the auction market theory describes the market is it moves in balance and imbalance, right? If you can correctly identify that we are in a balance, you can avoid losing a lot of money trading in chop. And then if you can correctly identify, oh, maybe this is a gap and push, and we're going into imbalance, which is like a large extension. I'll go into details about it later, but then if you click buy and it goes into imbalance upwards, you're going to make a ton of money, right? It's going to be a good trade. So that's some background about what AMT is. This is like the foundation. This is like laying the ground for like a floor for your house, right? We're building a house together right now. We're building like a skyscraper. The more I talk about this stuff to you guys, the deeper engraved it's going to be for me. So if you think, oh, why is he just pushing out all this free content? Because number one, I want to build myself a community of like-minded people, of like-minded individuals that are willing to put the work in, willing to watch this full video and this full series and learn and soak everything in and change their lives. And second, I want to spread this knowledge so people can stop falling for gurus, and I might make content debunking gurus and stuff in the future too, like Leon Ecom Debunked. I love that guy. But Okay, I'm straying way off topic. I tend to do that. So basically, AMT, we're gonna break down that, and then we're gonna break down the bell curve, the cycle of balance, and then the 80% rule that most people ignore, like when they're trading. So let's go straight into it. We're gonna go to the 70% value. Actually, it makes more sense if we go to the anatomy of balance, the bell curve theory, right? There is two primarily main charts that use this, which is the volume profile or the time price opportunity chart, the TPO chart. We will go into that in the TPO chart, especially in different details. I don't use it too much. I should use it a lot more than I should, than I don't. I think it's a great tool, and I think it has a very, very high skill ceiling too, and is very interesting. But currently, we will be focusing on the volume profile. As you can see, this is the volume profile right here, and this is the TPO chart right over here. Now, the bell curve, you can see it in action. You can see this bell curve, right? Let me draw it out. You can see this curve. It's like a bell curve. You learned it in statistics class, you learned it everywhere. And right, some identifying things is this right here. The highest point of volume is called the point of control, right? This is where the most action, the most interactions between buyers and sellers happened, you know? This is the price where buyers and sellers think is a good price. That's why there's so much volume there, right? Because buyers are like, hey, I like this price. I want to buy. And sellers are like, hey, I also like this price. I want to sell. And it's like, you know, and then it's a little bit different. I don't want to confuse anyone right now, so I'm not going to go into the time price opportunity charts, TPO charts, but you can see how they have this line on top, this purple line, which is the POC, and this line here. Now this line right here, I should use a different color. It's really bad. All right, this line right here, that is the value area high. That is basically the high of fair value, right? That is, sorry about that. That is the upper bound of fair value. And this top is the upper bound, and this bottom is the lower bound. I don't know if you can see it, but there's this bright colors here, and then there's this dark, and it's not as illuminated. You can tell that's the division. That's the upper bound, and then this is the lower bound, and then this is the point of control. And what happens is, if you do come from ICT, you're taught about there's a fair value, there's a good price to buy, you use the GAN box, you know, this, if it goes under here, it's good, you know, to buy and stuff. I don't know too much about it. I know I've heard about it before, but this is basically a more detailed version because it takes volume data from the markets and it puts it on that graph. So you can see, hey, this is the lower bound of volume. This is where, you know, sellers maybe lost some of that volume. Sellers don't want to sell even more, you know, right? You can tell right here. This is the point where price like just turned around, right? And you can see how it aligns with that value area low and how powerful that can be, some, you know, when you use it. And this is just a random value area volume profile, by the way. So at value area lows, you want to typically buy because price is 70% of price is within this bound, within this range, right? So if you reach to the extremes, like the upper or lower bounds, you know, mean reversion theory, you would, you know, like to take that trade from the lower bound to the point of control, or the upper bound, you know, that is statistically favored. So, right, not every trade you take with that is going to be a winner. And if anybody tells you that you can get a 100% win rate, you should probably run, because that guy's probably trying to scam you. So we're going to move away from the anatomy, and we're going to go into the 70% of value, the cycle of balance, and redefining the fair value, right? You keep hearing this thing if you're in the ICT community. Sorry if I keep bringing it up and you don't know what it is. You can ignore me during those times. But fair value gaps and stuff, those are low volume nodes, right? You can see it right here when price dips in volume a lot, but right, price expands a lot. You can tell right here that is a prominent level, right? This is a level to watch out for. You can see, and this level, time and time again, you can see from the chart that it kept bouncing off of it. It bounced off once here, twice here, 3 times here before it finally broke through, right? So boo long, boo long, boo long. 3 potential wins and finally 1 loss, because this is essentially a fair value gap, right? Essentially, it's very little volume there, but price flush down there, meaning there's one maybe like huge seller or huge buyer that interacted there and flushed it down, or maybe the book is thin there, maybe like there's a lot of things that could go on, but those are levels that you want to keep an eye on top of the value area highs and value area lows and point of control. Now the 70% rule is that price, you can see with the shaded profiles and the bright profile is the normal distribution. 70% of the volume will happen here. This is fair value. This is where buyers and sellers are interested, right? And like I said, again, point of control is where the most volume is transacted. It's like Earth's core, gravity attracts it there. That's why you see price keep going past point of control, back to point of control, past point of control, back to point of control, because that's the price that people are interested in. And you might ask the question, hey, we're in all-time high conditions right now, point of control, we don't go back and forth in range and stuff, and that is true. That's why I've been having a little bit of a tough time, because I'm used to trading in not all-time high conditions. But the thing with point of control is it can move, right? Buyers and sellers establish new point of controls all the time. Let's say start of a session is here, but then buyers are just so much stronger than sellers, then point of control moves up here, then price is directional, right? So that's another thing. An analogy that you can think of this is like a flea market, okay? You're at a flea market. If everybody is buying and selling vintage cameras for $100, that is your point of control, right? You go on eBay and stuff. What is the average price, the most amount of buying and selling going on at that price? That is the point of control, right? So if someone lists something for like $50, it's gonna be gone in a second, because dang, that's such a good value. And that's the same exact principle with volume profiles and auction market theory. I'll tie it back together later. I'm not going too far off topic. So with the volume profile, you can think about the y-axis as price and the x-axis as time, right? So as price decreases past point of control, past that fair value, past that value, and into maybe the lower bound, hey, this is like that $50 camera being listed, right? When everybody's buying it at 100, it's like, yo, it's $50. I gotta pick it up right now. That's why you see these reactions, right? At this value area low, this is why you see the buyer step in and push it higher. And that POC keeps changing all the time. Like Pokemon cards, one card could be worth $100. That's the point of control. Everybody's buying and selling at that. And then the next day, maybe a new set comes out, and POC, the price that people love to buy and sell at, lowers to like $25. Dang, there's nothing you can do about it, right? Okay. Now there is something interesting to note. There's such thing as an 80% rule. I know I explained it. Oh, I didn't explain it. I mentioned it earlier in the beginning of the video, the 80% rule. So this is a statistic for the NASDAQ, the NQ futures. If price opens above or below the previous day value areas, there's an 80% chance, or like, not really 80% chance, but there's the statistic, 80% of the time the price that opens above that fair value will come back into the value area, and then it can choose what to do next, right? That's why you see this, like, okay, off topic, never mind. That's why you see price push up during open, come back down during open, and then continue to push up higher, like that reversion back to the value area to fill in more orders and then continue pushing. That's something interesting to note, right? If you're trading, you notice, hey, we're way outside of the value area. Whoa. So I'm gonna think to my head, maybe it's not the best idea to buy at the very high highs, right? Maybe it's smarter for me to wait till maybe it reverts back to POC of previous day, reverts back to value area high of previous day, and then look for that buy. Or if I see huge selling exception, maybe look for that short, right? Okay, we're gonna go towards wrap it up with auction market theory. I don't know how long this video is. I hope I'm not a rambler. I hope you guys are learning a lot, because there's a lot of information here that you could apply right away. I'll show you guys methods to apply it, by the way, at the end of the video. This is very important. This might be common sense and easy for some of you guys. Like, you might be hearing this and being like, oh, Nathan, what are you even teaching us? That this all ties back. I'm telling you, there's a reason why I'm going over this first and not anything else, not a strategy, right? Because you make your own strategy. I can't give you my strategy and tell you, hey, go print money with this, because that's not how it works. Trading is with discretion, and that's why algos take a lot of edge. Well, not a lot of edge, but like a long time to develop, right? You need to build that edge. But I believe that humans have an emotional feeling, like a discretion that they develop over time after understanding these theories to an extent and stuff. So, moving back to the topic, there's sweet and sweet, balance and imbalance. Oh, I love this topic. You always see the stock chart go, right? Let me pull it up right now. You see this and you're confused. Why? Why is it going here? Why is it going here? Why is it going here? It's all about accepting value. You can see the volume profiles and be like, oh, this is the high, value area high, this is the value area low. But why? Okay, let me tell you. You see this big move down? That's an imbalance. And what does an imbalance mean? An imbalance is telling you that price is inefficient, that one side is way more aggressive, and that price must flush and move to a new price where buyers and sellers are like, hey, okay, I'm interested again. So in this example, right here, it was consolidating, and then suddenly an imbalance. Seller aggression overwhelmed buyers, flushed buyers out, and it dumped. Dump. Sure, there could be news that happened there, but what news that happened there doesn't disprove the theory. If you think like, oh, price only moves because of news and other stuff, half true, half right. Because price moves because of the participants, the buyers and sellers, and the market makers and other things, right? So when price moves through the imbalance right there, that means sellers are winning. And that's so self-explanatory, right? You might look at this chart and be like, oh, wow, so much selling. But I want you guys to put it in a different context where it's buyers are exhausted, buyers are flushed out, and sellers are dominating right now. It's a sense of imbalance, right? And what happens after imbalance? There's accumulation. There's a need to find balance again before it redistributes and finds another imbalance, right? It's so rare that you find price do this thing where it shoots up to a new price and it suddenly shoots down. That type of manipulation it's rare to find for big moves. Sure, there is noise during low volume times. There's other stuff, and it does happen. I'm telling you that it does happen because I get wicked out on it pretty often. Not pretty often, I don't know. But this is the rule of thumb. After imbalance, there's always a need to find balance, because if you think about it, hey, this price of a Pokemon card drops dramatically, we need to find a new price. And after it finds a new price, it stays at that price for a little bit before it can find a new price, right? So this is, you can see it happen. Bang, imbalance, balance, bang, imbalance, balance, 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 imbalance, balance, imbalance, you know? Okay, bang, imbalance, find balance, bang, imbalance, find balance, imbalance, find balance, imbalance, find balance. That's your homework for today. I want you to just go look at a chart. It could be anything, and just identify balance versus imbalance. Right, again, imbalance is market is inefficient, one side is more aggressive, and the rebalance is where sellers and buyers think it's a good place to establish control and start fighting again. Right? And you might think, how does this apply to all-time highs? How does this apply to the current market conditions? And I'll bring you back a little bit. Look, imbalance. Finds, stabilizes, balance a little bit. Imbalance, balance a little bit. Bleh, imbalance. Balance a little bit. Imbalance. Come on, guys. Come on, guys. Auction market theory. Right there. I just taught you crazy amounts of sauce that people had to pay probably thousands of dollars in courses and educations in so yeah, if that doesn't deserve a subscribe, you know, a like on the video, right? I'm talking too much. I'm just excited about this topic. I'm excited to move on to more interesting stuff, and so you guys can print money. And yeah, this mural board, if you guys want me to share it, comment down below. I think I can share it with you guys. I don't know how, but if there's enough interest in it, I'll put the link down in the description. Just comment if you guys want it. Comment if you guys want all the resources, like, you know, the templates and other stuff, and I'll give it all to you guys. I'll give all the sauce. And I do have a question for you guys. How interested would you guys for a free Discord community where, you know, you can ask questions, I can post like my ideas and our stuff. All right, I'll see you guys lesson 3. Bye bye.